got a couple, haven't we, coming up? Lithium and also uranium. I've got to forget that one. That's on everyone's tongue at the moment. So our moderator for this panel is John Stover. John is the Portfolio Manager and Managing Partner from Tribeca. And John, what I'll do, you're all mic'd up, aren't you? I will get you, Jonathan, to introduce all of your esteemed panel members to everyone, if that's okay.
Thanks very much, Chrissy, and thanks everyone for joining. As Chrissy mentioned, I'm the Portfolio Manager for the Tribeca Asia Credit Strategy. Decarbonization is obviously one of the biggest themes this week. It is going to be one of the largest collective human undertakings of all time. And we really see this as both an opportunity and a challenge. So obviously there's going to be a tremendous amount of investment opportunities on the back of this, but it's also a challenge for the corporates in terms of how they manage their own emissions and how they're communicating that with their stakeholders. So we wanted to have this panel to dig into both the investment opportunity set as well as discuss how mining companies specifically are handling this issue. So we do have a few experts in this field. I'm going to just introduce them and then we'll get straight into it. Andrew Wong, who's sitting to my left, is a director at TriRec, which is a global early stage decarbonization VC based in Singapore. Before joining TriRec, Andrew was a writing analyst at CLA's Taiwan Equity Research Department, covering suppliers in the EV and solar supply chains. He started his career in his hometown of Montreal at Deloitte. Thanks for being here, Andrew. Swetri Chong is a director and founding member of Decarbonisation Partners, which is BlackRock's joint venture with Temasek that invests in the next generation of innovative decarbonization solutions and businesses to achieve a net zero carbon economy. She has 20 years of experience in organizing, executing, and managing investments globally across the energy, environment, industrials, and transportation logistics sectors. Thanks, Swetri. Jamie Strauss, at the end there, is the founder of Digby, which is the only ESG disclosure, ratings, and communications platform designed specifically for the mining sector. Jamie spent previously over 3 decades in the mining industry. So with this topic, we'll sort of get right into it. I want to start with Andrew and Swetri. There's obviously been a lot of shifts recently, over the past few years in the VC and growth equity landscape. Specifically to decarbonization, what are you guys seeing in terms of deal flow, investor appetite, and terms in this space?
Yeah.
Let's start with Andrew.
Okay, sure. Well, I think definitely climate-tech, climate tech has been the bright spot in terms of VC trends over the past year or so. There's been a lot more deal flow, I'd say, in terms of opportunities, and also I guess more diversity in terms of the types of deals that we're seeing as well, right? So I think for us, we've seen quite a few, more so in the harder to abate sectors, whether they're dealing in the industrial side of things, whether it's in energy as well, right? So I mean, we've looked at things such as nuclear fusion, green steel, carbon capture as well. So I think it speaks to the amount of ambition that a lot of these founders have, and I think the willingness of investors to look at the space and put money into the space as well. And I think as we go further into it, I think there's also a trend about more people are looking to fill out that capital stack as well, right? I mean, I think with VC, a lot of people are focused more on the early side of things, but I think now we're seeing people more willing to go into that mid-stage side of things because I think a few things have been de-risked, right? I think maybe from that debt financing portion of things, if you're building a plant or facility for a first-of-a-kind type of deployment, then I think that's super important. And then as you move further down that capital stack, right, I think more and more people will come on board as well. So yeah, more deals, diversity of deals, and I guess more players coming in that space in terms of types of investors.
Sure, thanks.
Yeah, for me, I speak from a perspective of a growth equity investor in the decarbonization space. I will take a step back and kind of look a little bit back at history and versus now. What we're seeing now is that there's a general sense of rush of capital to the decarbonization thematic, but in reality, there's really quite different pools of capital at play, and they don't necessarily commensurate as what I see now. Just for context, during Clean Tech 1.0, we have about 140 kind of VC funds, generalists investing in the climate tech space. Today, we have about 170 over VC funds, specialists in climate tech investment. And this is just amongst the 2,500 over VC funds that have invested in this space in the last 2 years. So what it tells us is that there's just a lot more allocation of capital by early stage funds in the space but there's still insufficient funds looking to fund companies for their growth stage. When we look at absolute dollars, we're talking about $2 billion of capital during Cleantech 1.0 2013, and now we are about 30 billion of capital chasing this space. So there is money there, but the money is not evenly spread out, let's put it that way. And for a company, when they need to go from a development stage after developing the technology to a deployment stage, you need 10 times of capital to help the company get there. And today, the amount of capital that's available for the growth stage, we're talking about just $1 of capital available for every $3 of demand there. So all in, I think we just need a lot more focus on the growth stage. All these companies that we are backing in the climate tech space, they tend to be some form of a CapEx spend, right? Because we are building new machines, is essentially. So that's where I see kind of like different stage of funding available for the space. And maybe just one more point to add in terms of like the deal environment that we're seeing in the climate tech space here. I think not unlike the typical private equity environment, investors are getting more cautious for sure. People are focusing on sound business model, good technology, but increasingly we're seeing trends like slower exits in terms of IPO, M&A, meaning that companies will have to stay private for longer. So more opportunity in terms of private equity investments. Other things that we are also seeing is more insiders actually coming in to help bridge the company to their next milestone before they go to the external market. So quite important to have deep pocket shareholders there for the startups. And I think last thing is like the terms and valuation we're seeing, also some moderation there in terms of expectation by the founders. But all in, there's still a lot of dry powder that we're talking about in the space. It's all about finding the right fit in terms of the technology, the company, the valuation, the terms.
Great, thanks. And turning to you, Jamie, I mean, you're focused on ESG more broadly, but within the E component of that, what trends are you seeing from the corporates in terms of decarbonization action and reporting, and how is that impacting investor appetite?
Yeah, thanks, John. I think as actually just coming back, I think we need to take a step back. I mean, if we break down the carbon output, I think steel and cement is 5.5 billion carbon CO2, and I think direct mining is just about 500 million. So it just kind of puts it into context as to what the issues are. But if you look at the big trends, look, governments are still pushing for the decarbonisation. So that's the first thing. The second thing is governments and others are pushing for responsibility. And I think if you look at one of the big trends we've seen, we just saw the previous presentation from Magnetite and Tim Dobson. I mean, that's huge, and it's happening in front of our eyes today. This has a huge impact in terms of not only the capex with regards to the steel industry and the mining industry to reposition the sector for certain DI product, but also the huge capex that's going to go into changing the blast furnaces. So I think that's a huge element that kind of affects one of the largest part of the mining quantum. But E is not just carbon. E is many other things, and I mean, we can look at the internal power of mining companies as we get new hydro coming in or other means of sustainability going forward. Some smaller things, but really important, is to increase monitoring of electricity and how mines are using that electricity to go forward. We've got equipment providers such as Komatsu doing joint ventures to come up with zero-emission trucks. Biodiversity action plans are happening after TNFD was announced last year. Biodiversity action plans are happening across all producers at the moment and beyond that. There's now an encouragement by ICMM and others, I think came out earlier this year with a nature positive approach. A really important part, I think, of trying to change the transformation and the perception of this sector. Local agriculture, another real focus when it comes down to the operational side, to support local communities as part of local agriculture, making sure there's less conflict there, improving prosperity, education and health goes into that. We've got noise and dust as well, which is, of course, an obvious issue, which has always been around mines, and how we can remove that along with vibration. Water, I mean, there's a list of 6, 7, 8 different things with regards to water as they fit into the environmental thing, how we improve that, and that definitely affects the social side of local relationships and everything. So the new mines of the future are incorporating all of this as part of that E. It affects very much the social side, so very much the interoperability between those two. And then that really comes down to, I guess, none of that is possible without the G as well. So even though the question was very much, where are we on the E, all of this is integrated within each other. And how does, the second part of the question is, how's that affecting the investors? I mean, there are huge diversities here. I mean, there are a lot of junior companies here who can still get away with $2–3 million fundraisings and not have to deal an awful lot with the disclosure and reporting of ESG. That's a fact of life. I think it's probably changing, it's evolving, and it will come further as smaller companies get pulled into some of the compliance and requirements. But beyond that, I think we shouldn't be blind to what the supply chain is asking for. I was talking to companies this morning about some of the OEMs, both in China and in Europe recently, as to their demands at the moment. That's increasing. We've just seen the ESG requirements in China being improved, announced 4 or 5 weeks ago. So ultimately, I think really where it comes down to is investors want to reduce risk. Sustainability and responsibility is a way of doing that. They want to protect their reputations. They want to ensure projects that they're investing in are sustainable for the future. And so that they can enter the supply chain with not necessarily premiums, and today's not going to be a conversation about premium pricing, but to make sure that they enter that supply chain accepted as being sustainable.
Sure. Yeah, no, thanks for that. And so I guess there's a lot of really attractive, exciting opportunities and sort of sub-segments within decarbonization. I wanted to touch on a couple of these, both of which your funds are invested in, mobility and battery recycling. And maybe Swetchi, we'll start with you on mobility. I mean, what makes that such an exciting part of decarbonization, and what are you guys doing there?
The electrification of mobility has been quite a central focus within the thematic of decarbonization. And one of the key reasons driving this sector's growth is really around the de-risking of it being an asset class. From a technology perspective, this is a proven, reliable, declining cost technology. When you look at it from a total cost of ownership perspective between internal combustion engine vehicles versus electric vehicle, we are parity in a lot of places, and that definitely helps to drive a lot of the adoption. The other thing I wanted to mention is that with this, this total cost of ownership kind of getting to parity, it means that it has opened up an entire value chain of EV that is open for investments from not just your OEMs, but all the way to your charging technologies, your softwares, as well as your battery technology there. And then if I split this sector from a geographical perspective, each region, country has its own space in terms of the adoption curve. China, being the most advanced EV economy in the world, has evolved its value chain so much that we're no longer just talking about passenger OEMs makers as investment opportunity. The spotlight now is on, for example, commercial EVs as a service, whereby large logistic companies are very keen to decarbonize, and they are leaning on services company giving them a full wrap service all the way from leasing, insurance, as well as operational and maintenance. And then looking to South Asia, India, another very interesting place, has its own unique way of developing the e-mobility space, very much focused on the three-wheelers and the two-wheelers market, which fits the price point for the stage of the economic development there. And I can't help it being very geeky about the battery technology, is that battery technology is going to drive a continuous cost down for the EVs. It is a key pillar for that. And when I look at the technology development in battery, there are lots of them. But what is immediate is really in this particular space for the anodes of the battery. I'm very, very excited about this technology in the silicon carbon anode space, whereby it can increase energy density of batteries significantly, increase the driving range significantly, increase the charging rate significantly, and hence driving adoption. So companies like Group 14, based in Seattle, is one example where it can drive the energy density up by 30–50%, drive down cost significantly. And what's important for battery gigafactory manufacturers, if any one of you out there, is that it can actually increase your capacity of a gigafactory by 30–50% effectively without having to put in new capital investments.
Excellent. And yeah, Andrew, how about on your side in terms of the batteries recycling?
Yeah, no, I think for us, right, that thesis has sort of evolved as we created new funds. So originally we were focused more on the battery chemistry side of things, but we ended up not deciding to invest there, and we invested in charging infrastructure. But I think now with the trend of electrification, that's what she mentioned. We're at a point that you're sort of at this critical mass of potential batteries that can be recycled. So that just increases the market size, makes it a lot more attractive for investors, for starters to come in and solve this problem there. And then secondly as well, I think from that technology side of things, right, the technology that's being used right now in battery recycling, it really revolves around just two things, which is pyrometallurgy or hydrometallurgy. It's either you're burning it up or either you're running through a chemical bath. So I think there's a lot of room for innovation there, besides things like direct battery recycling, which we think is still a bit further down the road. I think improving the current status quo is I think the way to go here. And then also thirdly, I think from that access to minerals point of view as well, right? A lot of talk about where do we get these minerals? How much of these minerals are, right? And we saw the spikes of lithium, nickel, cobalt over the past few years. So how do you get like a stable supply of that? I think battery recycling helps address that problem as well. And I think finally, from geopolitics point of view, right? I mean, the world is sort of splitting into two now. So your battery recycling plants in China no longer maybe can't be relied on 100%. So people will be building these new battery plants around the world, whether it's the States, wherever it is. And actually, quite a bit of the scrap that comes from that's sourced for EV recycling is actually coming from the point of manufacture. So with all these new battery plants coming up, there's going to be a lot more sources of battery scrap to use for recycling. So I think this, all these factors really led us to believe that battery recycling is the way to go, and not to mention the favorable regulatory environment that's being put up in the EU and the US as well, right? So so we did end up making an investment in a company here called Green Lion. So they do exactly that, which is help improve that process in terms of the hydrometallurgy process there that cuts out a few steps, and you get right to the that cathode active material that people are looking for. So no, I think there's a lot more room for improvement, and that's one of the reasons why we're investing in that space.
Excellent, thanks. And I wanted to touch on also, obviously this being a predominantly APAC-focused conference, the differences between APAC and other regions. Obviously, APAC historically has been seen as a laggard in decarbonization and ESG relative to what's happening in other regions. But I think if you look at where the lowest hanging fruit is and where the greatest opportunities for improvement are, I really believe it's in Asia Pacific. So Jamie, I mean, from your side, what are you seeing in terms of the companies, their attitudes towards ESG disclosures in APAC versus the rest of the world?
Yeah, I mean, I think if you look at the flow of funds, I mean, I think in Australia, 46% of all funds under management are now sustainable in one shape, form or another. I think the fastest asset class in China is ESG funds at the moment, from what I last read. So, follow the money, as they say. So I think, to some extent there's been a bit of catch-up, but I think is now kind of getting closer to that, not maybe parity with Europe, but certainly moving in that direction. The impact, I think, has got to be seen on both sides. It's, it's a kind of risk mitigator from some angles with regards to portfolios, operations, and reputation. But at the same time, it's a value enhancer. And I think, the sector we've got to respect that the mining sector generally is regarded as the least trusted, most low valuation and high cost of capital sector against most of its peer sectors. So on that basis, how can we drive confidence, trust, and execution through that, and through the means of doing that, and therefore being able to feed the decarbonisation story and obviously the electric revolution that we're seeing. So from that perspective, I think there are some really great opportunities. How can we mitigate risk for portfolio managers? How can we improve the time to go through due diligence processes? How can we be better prepared? How can we prepare these how can we prepare these assets for the future so that they enter the supply chain in a more effective way which meets the requirements of the supply chain. So yeah, I mean, follow the money is what I would say.
It's a good theme, yeah. And to touch on that, we were going to run through the APAC investment opportunity versus the rest of the world, but I think we're running out of time here. So you guys will have to grab Swetchy and Andrew to discuss that for a coffee later. But I want to thank our panelists for their time here and their views. A lot of interesting points and themes that they've made, and thanks everyone for listening.
Thank you.
Thanks very much.
Thank you.